365, shake my hand. Hope you guys are doing well. Traders, I've seen this happen the whole year, the whole of 2022, where markets are falling. Sometimes traders are in perfect positions, then the psychology starts to whack them across the head. They quickly close their positions. Sure, it's a swing trade. They held it for a week and they think, victory has come, or they see retracements coming and immediately they think, well, it's time to buy now, or selling has stopped, etc., etc. Well, in this video, this is one of my public lectures. You're going to meet old or younger Leroy from about a year ago, 2 years ago. I can't really remember, probably 2 years ago, before I even had a YouTube channel. In this public lecture, I broke down how to master retracements, right? The correct tools to use for retracement trading, because the trend is never over until institutions actually change the imbalance flow between buy orders and sell orders. So I really hope you enjoyed this video. I hope you enjoyed this long lecture that I did. It's absolutely crucial. Fibonacci tool is one of the most impactful, useful tools that I use in my trading. It helps me in a couple of things. Number one, stay calm, stay collected, right? You can still hold the position. Let price get to this level and then retrace to go down. Number two, it helps me know when to add more. So I start to scale in more positions while holding my original high sell value, which means by the time or on the day I finally take profits, right? It's not just one trade I'm closing out. It's a series of trades that I kept opening, because markets move in zigzags and in continuous retracements. And a trader who has not mastered those retracements will generally always struggle. So in this particular public lecture, I've done a fantastic job of just breaking this stuff down from beginner level all the way to pro, how I use the Fibonacci, why I never think twice about closing long-term swings because I understand that we're currently in a retracement. How do I identify a retracement? As a trend reversal or just or a trend pause? All those kind of simple concepts that sound simple when being taught become very difficult when your mind is linked or connected to the amount of money you have on the table and you're scared to lose it, right? So I really hope you enjoyed this video. And if you do, let me know down in the comments, man. I can break down these basic stuff for you on a day-to-day basis on the channel. Don't forget to subscribe. Don't forget to like. 365, boom. So that's really what I want us to look at, right? So markets trade, what was my main point, and also people was coming to the Zoom meeting late. I started late, but it is what it is, right? So markets have this mindset of either buying for a very long time or selling for a very long time. The first thing you need to know about Fibonacci, which we'll talk about in tonight's session, it won't go over an hour, okay? I guarantee that. Unless, again, I see more trade calls, or if you guys want to talk about other Fib-ish related things, right? But the first thing you need to know is the difference between a retracement and a reversal. It's going to clash. If you don't understand retracement and reversal, you're going to make the wrong calls all the time, okay? That's number one. Number two, when it comes to buying and selling, which is the only thing we do, by the way, in the markets, right? You buy or sell. Sells have a tendency to happen sharper and quicker, right, than buys. Buys generally are very choppy. Okay, well, we're going to get into that. Now, if you're a 365 trader, and I'm just going through the Zoom names here, and I know there are a couple of you, actually, a couple of you in there, and a couple of people I don't know. Welcome if we've never met, shake my hand. But for 365 traders, thank you so much for coming, even though we've done Fib 2 in our module 2, like in the actual course. I want to do something new and special for you guys who actually attended. So I want to bring in a little bit of like a pro tips, like in between, right? So it's nothing crazy, it's nothing amazing, because what you already know, right, from your module 2 is enough. Okay, and when I speak about module 2, because my laptop looks like it wants to give up on life, right? I'm not gonna fiddle with it too much to kind of like show it to you, but I wanted to anyways, right? So let's start off with the whiteboard. I see someone in the Telegram group is asking if the Zoom meeting has started. Well, yes, it has. Okay, so thank you, Mark. So Mark has responded. Fantastic, because I really can't do too many moving pieces and it drives me mad. Right, so let's start off with the whiteboard. I'm so used to the whiteboard being on this side, and I know I'll be in and out of the camera view. Right, and in the whiteboard, I want us to first really visualize this thing, okay? The Fibonacci, guys, is a notorious market mechanism
that is undoubtedly part of the markets, but universally in terms of its DNA structure, right? It's something in the world. So for example, security cameras, CCTV cameras, when they're doing that thing, tracking your face, what's it called? Identity tracking or whatever. Let's say you're in America and you steal and they want to kind of like facial recognition. That's what it's called. The facial recognition software, it's quite a complicated coding thing, blah, blah, blah. I won't pretend to know it, but for the most part, it will break up all the different types of faces to fib level segments, right? Basically to match you out, okay? No, it's just pretty much Fibonacci, right? So there was this Italian mathematician a long time ago who basically figured out that there was a mathematical sequence to everything. That everything in the world could be given 100% quantity. So there's 100%, but there's also 100%. It just depends on what you're measuring. And in that 100% or 100%, you could actually subdivide the structure into smaller parts, into 30%, 61%, 27%, 12%, 78%, as long as the total, right, if you're with me, the total came to 100, all right? And this Italian mathematician then created a mathematical equation. Someone has got power to draw on my screen. Just whoever it is, just be mindful of that, so that when I start working on the whiteboard, me and you are not competing there. It's just a weird setting. It's not your fault. Zoom does that, etc., etc. Right. So back to what I was saying. So what we do in the markets is, and it's a complicated thing that I can't really deploy in 1 hour. I'll do my best. Number one, when you're looking at the charts, you're looking at something called field orders. Printed orders, okay? And we talk about this in greater detail in the actual course. Wait, what am I sharing? What do you guys see? What do you guys not see? Do you guys see my whiteboard? It's still just the whiteboard by any chance? Can you just confirm? Am I sharing my whiteboard?
I see the whiteboard.
Whiteboard, fantastic. All right, no, that's perfectly fine. And then I'm just going to quickly mute everyone. So I'm just getting feedback in my speakers. Right. So when you're looking at candlesticks and you know those price action guys or those pure market, that whole group of human beings in the world who read candlesticks in a particular different way. At the end of the day, whether you understand that stuff or you don't, whether you understand the doji, hammer, morning star, shooting star, that's how most of us start in this game, right? This is now 8 years ago, right? Candlestick Bible, all that stuff. If that's how you trade, it doesn't really matter what you think you're looking at. At the end of the day, the only thing you are seeing is field orders. You're actually watching what the market has done. When I'm talking about the market, I'm talking about smart money. Smart money is moved, has sold and bought and maneuvered around, okay? Around individual retail traders or smaller companies, etc., etc. Your job then is to deal with the leftovers in the market as a retail trader. And hence the different strategies and the different indicators and all that kind of stuff to predict, right, a pattern. That's all it is. Support and resistance, looking for a pattern. RSI, oversold, overbought, looking for a pattern. Divergent sales, the MACDs, all of these things are looking for a pattern. Elliott waves, Dow theory, all that crap, right? You're simply looking. There's even a term called pattern trading. Okay, that's all you're doing. You're trying to map out if there's a sequence, if there's a logic to the madness of field orders, which is a horrible approach, right? So if I could edit videos, that'd be this cool thing of me throwing that thought away. It's a horrible approach to markets. When you see field orders, when you're looking at those candlesticks or whatever time frame, whatever chart it is, I want you to start understanding something. You are looking at prime trading psychology. You're looking at the understanding of market makers or market controllers or domino effect holders. Goldman Sachs, JP Morgan, Ray Dalio's hedge fund, of Bridgewater, Warren Buffett's hedge fund. Looking at hedge funds, fund managers, and central banks, FOMC, the Bank of England, Reserve Bank of Australia. That's all you're looking at. You're looking at a global understanding of where price needs to be. Okay, I'm going somewhere with this. So 365 traders, I'm pretty sure they're probably yawning because they've heard me say this a lot of the times, and they've done my course, so they actually understand what I'm talking about. But it's very, very important we nail this detail right now. If you're joining us on the Facebook Live, I see we're finally running. We ran a bit late on the live side. Shake my hand. Thank you for joining. I see people are still registering. So at some point, I'm going to have to pause to admit them to the Zoom room, right? But in any case, it's very important to know that you are dissecting the trading psychology of the top 10% of the market. But inside those field orders, you're also going to be looking at the trading psychology of your peers. By peers, I mean other average, losing, non-consistent retail traders. So when someone says, I took a sell on a trend line, Leroy, but price faked me out, right? It sounds like you've said something deep and it's like, oh my God, markets are faking you out. No, you're looking at the global average of a decision that was taken by a couple of hundreds, if not millions of traders who thought it was now time to buy when smart money was selling. Very important. Once you understand that, you then need to understand that markets have a sequence. Now, I can't talk to you about Fib before doing what I've just done. It's very, very important. It's going to be very difficult, as usual, for me to attend to questions on the Facebook Live. I will do my best to do that, but it's easier if I see stuff on the Zoom chat, right? If I see stuff on the Zoom chat, I can respond a little bit quicker there. Right. So on the whiteboard, without really. Thank you so much, Eunice. I'm seeing your chat now. Fantastic. On the whiteboard, guys, without wasting too much time, the first thing I want to do is I want us to kind of like map out Fib for ourselves here. Normally when I teach in my trading course, I use a lot of the whiteboard to kind of like de-link us from the markets for a while, right? So I want you to see this thing in its purest sense, okay? And maybe before I even start with that, I think it's very important, right, that I mention a couple of things. I'm not teaching you the Fibonacci as a strategy. I don't think Fib is a strategy. There are many Fibonacci strategy traders. I don't think it's a strategy. I believe the Fibonacci, or at least in the academy, and my students will tell you, is a tool. It's a simple tool. It's like learning how to read Braille. Braille, blind people use Braille to read, right? It's like filling. It's a tool we use to fill market structure. So in tonight's class, because this is a free public lecture, I will teach you how Fibonacci operates. Sorry? Was that for me or not for me? All right, I'm just going to move on. I think I heard someone saying something on the speaker. Right, so please feel free. If you've got questions, just chat. Instead of unmuting your mic, just drop them on the chat box. I promise you, I'm very quick there. I'll be able to review, see stuff, and work on it with you. Right, so the Fibonacci is a tool, at least in how we do it in the academy. And the reason for that, and you must understand this, right, is because in the academy, we are all institutional traders. If I'm teaching you how to trade, there's no time for support resistance indicators, Dow theory, Elliott wave, MACD. There's no time for that. There's no time for retail strategy. I'm going to teach you how smart money operates. I'm going to teach you how to read the charts. You're not going to do a fundamental course with me. It's all based on market structure. I teach you how to read market structure. And from that perspective, we are constantly looking at institutional order blocks, right? So this is very important. I bring it up because I can't cover this in tonight's free class, right? But I'm simply saying we use the tool, or we use the Fib, right, as a tool to assess or confirm order blocks. Because the only thing that we trade in the academy is order blocks. And by order blocks, I'm saying we only buy or sell where smart money is going to buy or sell. Because where smart money is going to buy or sell, smart money has already left money in that area of value to push price up or to push price down. Again, none of my free classes are generally open for like strategy debate because of time. Like if you feel like your strategy is awesome and works out for you, that's perfectly fine. I'm not here to debate with that. I'm simply saying this is how we do things. So when I'm teaching you about the Fibonacci, I really need you to remember this thing, that there'll never be a time where you can use the Fibonacci, find a level and think that Leroy is going to buy or sell there strictly because of what I'm going to tell you tonight, because it's just a fib. Leroy is going to take that information of the Fibonacci and match it with an institutional order block, right? Which is something I can't teach you tonight. There's just not enough time for that, right? It's like order blocks are 4 weeks in my module 1 course. It takes me 4 weeks to get you through all the order blocks, 3 times a week, blah, blah, blah. So tonight, but there is a benefit in tonight's class, which is even as a retail trader with your retail trader strategies, the 20%, 30% support resistance strategies, you could potentially better, right, your consistency. Okay, very, very important. And that's kind of like the aim, right? So I'm seeing a lot of people joining in. I'm just going to quickly admit them into the room, and we're going to continue, right? So on my side, Facebook looks frozen. I'm assuming it. I'm hoping it's going well there, right? So number one, the first thing that I teach you normally on week 1, week 2 of my Trading Academy course is you are most likely going to be taught that markets move or trend in the structure. And they break the structure to create a duplicate structure. And this is simply via, if you sit through your broker's regulation cluster, there is a regulation rule for every single broker to have an education process, because people risk money into the markets, and markets trading is a risky thing. In fact, I should probably say that in every single video that I put out, that you will lose your money in trading if you don't know what you're doing. It's not like a job where you work for 4 weeks and you get a salary. Every wrong decision you make in trading, you will lose money. Now, when my YouTube series comes out on trading psychology, I'm going to talk about the problem with accumulating so many small losses in your trading career and how that will impact you later on. Because trading psychology is the game, all right? But for the most part, every single broker must have an education platform to introduce themselves to you in a legal parameter. And so they'll flood you with a lot of analysis. I mean, a perfect, beautiful example is who funds. No one asks these big questions, man. Who funds baby pips? That's 368 free lessons on markets. And it's a good resource, right? If you want to know market terms, market terminology, what are pips, learn about the basic strategies. It's a perfect free resource. But who funds it? You can follow the money, man. It's there on their website. Just find it and read it for yourself, right? There is a reason for that, because if I can get 2 million customers, I'm just talking as a broker, just work with me here. My job as a broker is to get you to trade, not to open an account. That's a given. But I still don't make money if you have an account. My job is to get you to put money in the market. You understand? To trade. Now, if I can get 2 million clients thinking along the lines of support and resistance, I now know where 2 million of my clients are thinking. There's a high probability that the cluster of clients that I have, and if you've been to the course, you know that brokers have 3 books where they keep all their clients, right? The hybrid book, the group A book, and the cluster group B book, right? Obviously, you have to arrange your clients because different market conditions are given, because you get given different liquidity providers, right? This is from the broker education style, but I just want you to know that it exists. Whether you know it or not, you're in this rat race. Now, if I know that the majority of my clients have a high probability of selling there because of something that's common knowledge now, for example, resistance, right? Let's say there's a resistance here. I can, as a liquidity provider, right? Broker liquidity provider, use capital. Remember, you got $100 here, or 200, or 1,000, or 10,000 US dollars. That's still little money in this game. The markets make $5 trillion US dollars every single day. Little money. So I can, as a liquidity provider with 1 billion US dollars, overshoot this level. Why? I got to create a pool. I have to create a pool. This is trading psychology, but it's linked to Fib. Just work with me here. Very important. I have to create a pool base, a custom. I've got 1 billion. I'm the liquidity provider. I want to sell, but I know that a lot of retail traders are going to sell there. You with me? I want to sell, but I know that a lot of retail traders are going to sell there. If I'm selling, I need a buyer. There has to be someone on the other side of my trade. We need brokers to open up us into the market so we can find these people. But brokers have the backward upper hand where they can create this market for themselves. So what do? They overshoot the price, right? Why? Because they've got the money to do that. If I've got 1 billion and I spend 25 million US dollars, I'm throwing numbers around, but this is a very realistic thing. If you check the commitment of traders report and you actually get down into data, or you Google Goldman Sachs report where they show you their winning and losing dates, but you read the report is about 91 pages every financial quarter. They literally have to, by regulation, write out, the narrative of their strategy. They write it out. We literally pumped in $25 million north short just to sell. They went short long, pump markets up so that what happens? So you check here on the whiteboard. So I put 25 million bucks to pump it up. Retail traders are here, boom, 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 waiting to sell. So what do? They pump it up. All my stop losses get hit, stop loss hunt. Retail traders naturally, like bees to honey, start to fluctuate, right? I misread it. Prices going up. So what do? I want to sell. So what am I doing? I'm creating a pool. I'm creating a market for myself. I'm creating buyers. Because if they see the trend is your friend, we don't do that stuff in the academy. The trend is not your friend. And if it is your friend, it's only your friend at the process of compounding. In the academy, when we take buys or sells, we take them before they happen. We look crazy. Every time I'm in a buy, I guarantee you the average trader is holding a sell. And that's how smart money operates. 9 out of 10 times, if you don't look crazy when placing the trades that we place normally, like I'm talking about swing trades. I buy because there's a sharp bottom, and I sell because there's a top rise for a buy. Like the old Warren Buffett thing, be greedy when they're scared, be scared when they're greedy. That's literally what he meant. And he put it in his book, like he maps it out in the stock market. The exact same thing I'm laying out here. So I'm hoping it's making sense. So I pump the market up to a point of the failure as a retail trader with $100 US to hold my stop loss. Because my stop loss is worth $10 or $30. It's going to get hit. So I pump it beyond that. A lot of people sometimes call that a stop loss hunt, right? And sometimes they misread those things, but that's another topic for another day. But at the end of the day, after I've been hit, I just lost $30 of my $100. I'm going in now for the buy because I've got that clarity of mind that I missed the trend. It's a buy trend, right? And then you get the fake out. Poof, market drops. Why? Because all of a sudden there's a fluctuation of buyers, right? They bought late, broke the rules. You buy low, you never buy high, like a common rule that happens all the time. Now, in this particular dance in the markets, what a lot of retail traders, whether they use the fib or not, is they miss out on the simple fact that markets generally move in a structured basis, okay? In a structured Fibonacci sequential basis. And that's what I want to help you guys with tonight, if that's okay with you. I really want to focus on that so that you can see, you can avoid the traps. Now, I know I make fun of support and resistance quite a lot. If that's the only thing you know how to trade, there's nothing wrong with that, okay? There's nothing wrong with that. But again, I'm not spending my nights doing this for fun, all right? I really am quite passionate about what I'm doing. It's just kind of like to open a lot of retail traders' eyes. So I'm not knocking you as a person. I'm just simply saying there are some strategies that will offer you 20% wins and 80% losses, and other strategies that will push you at an 80% win with 20% normal losses. You kind of like logically, you kind of like have to understand what you want. Now, this was my argument earlier on. I'll quickly share my screen so that you can see what I'm referring to here. I just Googled the word Fibonacci sequence, whatever, and I'm just going to go to images. I do this in every class when I talk about the fib. I just want you to see this. There's Fibonacci in everything, right? So what happened is a long time ago, and I'm talking about pre-capitalism. So if you don't know me, I'm actually from sociology, from the social sciences. That's actually my background, and a lot of the stuff, the big debates. Karl Marx was an economic, political economist, right? Sociology and economics we're under one thing, and that's kind of like how I approach the markets. I use a social science perspective, not a hardline orthodoxic economic perspective, right? Another conversation for another day. But basically, before pre-capitalism, long before pre-capitalism, the Japanese we're trying to figure out the rice market, right? The rice market. So that's how the candlesticks come about, because they were trying to map out seasons, rice seasons, winter, rain, and what impacts the rice harvest. When is there supply for rice? When is there demand? And how do we capitalize? And that's kind of like how futures, the futures market comes about later on again. They pick this stuff up, the sequence, this Fibonacci sequence. But at the end of the day, this thing is everywhere. It's in nature, right? It's in a flower. You can literally redigitize a flower simply by using the Fibonacci thing. This is literally on Google. It's not like Leroy is just making stuff up because he's bored, right? There's an egg, your faces, everything literally is. I'm just trying to make that point. Fibonacci was always there in everything before it came to the markets. So what we did then was, and when I say we, I mean they start to match out. Can we track, right, trading psychology? Because that's really what it is. Another good term for trading psychology is trading decision, okay? It's trading decision, right? Can we track the consistent flow of trading decisions across the platform by tracking the fib? Does it match? And the answer to that question was a big yes. Now, back to the whiteboard, because I think I'm done with that introduction around the fib, and I'm just going to close this here. Markets move like this, guys. Whether we agree or we don't agree, tonight is not the night, right? If let's say price is dumping, it'll go down, come back up, go down, come back up, go down, come back up, go down, come back up. Guaranteed. That's number one. Retail traders in general are taught to focus on stuff like this. So what I've done there is I've just painted the bigger picture, right? But for the most part, this is all they see. And it's your indicators, your basic support and resistance training. You're looking for a breakout, you're looking for a retest, you're looking for a strength, you're looking for a support to into resistance into support. So you keep bouncing up and down. The banks know this. They understand it very well. And they pump money in that direction to give this thing credibility. Okay? So I'm not saying support resistance doesn't work. I'm saying it only works 20 to 30% of the time profitably because it's designed by them to keep you in that loop, okay? But in the actual sense, if there is a reason, according to smart money, to sell in a long-time trend, they are going to sell. But they're going to sell at a very specific place. They're going to sell high, they're going to buy low, right? There's a whole technical conversation about that. But most importantly, it is the Fibonacci that can help us more so than any other tool that I know of, at least, to catch these pullbacks. That's number one. And to understand these as pullbacks, as retracements, not as market reversals, because I said that's another thing that we need to be very clear about. Now, a retracement, right, which is what I'm talking about tonight, a retracement means the trend will continue. The trend will continue. It has to continue. So if I'm going down and then I see price coming up and I've done a whole lot of other technical things to test my levels, to understand flow, a lot of complicated stuff we teach in the academy. If I understand all that stuff, I can then look at my charts and say, all right, cool, this is just a retracement. That is, the bulls haven't taken over. In fact, smart money, because smart money wants to sell high, I'm just going to use the sell example for now, because they have to sell high. It's the only way you make money. If I want to sell you something, for me to make a profit, I can't charge you the price I bought it at, right? This is a glass water bottle, okay? If I bought it for $1, I can't sell it to you for $1. I'll break even. If I sell it for 90 cents, I'll make a loss. So the only way I can keep making money by selling bottles is every time I need to sell it, I remember that I bought it for $1. And so the only thing that's progress in my life is if I sell it for $2. And the next time it comes back, I sell it for $3 or $4, right? Same thing in the charts. Smart money is going to continuously be mindful of this thing. That listen, there's no ways in life. I started to sell here. Gotta show you something else just to make this thing candlestick open and close. Open and close. Very important. I don't do candlestick patterns, okay? But this is like such powerful basic market knowledge that a lot of traders forget to go with inside the trading. I'm going to share my screen with real quick. This is a green candle. Simple rules apply. Most of you in the Zoom meeting and those of you on Facebook, you understand this stuff. I think you do. The logic is quite simple. A green candle opens here on the low, open, right? This is the low. See, this low opens right there, but closes high. Because for me to make money, I must start at low. I must buy it for cheap, buy low. But if I'm going to make a profit, I must close high, right? Sell high. So I must buy it for $1, but when it's now time to resell it, I'll sell it for $2 or whatever, if it's an asset, okay? But a bearish candle makes a lot of sense. If I'm selling you something to that buyer, I'm gonna wanna start off selling high. I'm gonna say, dude, this thing is $2, not $1. Because it's so all red candles, all bearish candles always open at the top, because that's where sellers are and they close at the bottom. Okay, so this is important just for basic market understanding. And I know it sounds simple, but a lot of traders have a tendency to forget it. Now, when it comes back to our whiteboard drawing, which I hope I am now sharing, I'm trying to be very good at the screen today. All right, when it comes up here, what it means is if smart money sold up here, sell high, they took profits here. You see this? They took profits there because this is the sell leg. I'm just work with me here. So let's give it some room. So let's say they sold this Euro USD at $20, right? And it's going down. It's 19, 18, 17, and they took profits there at $17. So here they've made $3 in their sell. They can't continue the sell there at 17 because remember, green, you have to open low. So they have to find buyers. Either they use their own profit funds to pump price, to give it a fictitious, fake temporary value by pumping price up here. So because the buyers have to start low, so they have to rebuy the same asset for $17. They're going to buy it up. And it's cheap because remember, they sold it for 20 and push it to maybe, I don't know, let's call this 19. I'm hoping you guys are with me. The logic is, let's say this is 9, let's make it 18. So they push the price back to 18. So now they've made profits of $1 there. Is that making sense? Man, I always worry, but I really hope it's making sense. So here I've made money by buying low, buying at 17 for something that someone clearly mistakenly might have bought it at 20. Why am I saying someone bought it at 20? Because smart money sold it at 20. If smart money is selling something at 20, there's some idiot. We call them dumb money. 90% of the time, that's retail traders. Those fake outs, those, I don't understand, price left me, price went the opposite way. All those moments is when retail traders are being viewed as dumb money. Smart money wants to overprice an asset, so they'll sell it at $20. Retail trader will come and say, I'll give you the $20 and not negotiate for a lower buy when buyers are supposed to buy low. So now they've made money here going down for $3, made money pumping back up, right? And now they're selling at 18 and now they're going to make more money all the way down here to $10, right? So now they've got $8. So now you are still stuck because you might have bought this thing at 20, closed on a loss, trying to realize it, ran here to make a buy, realized that it was a short buy. As you were going up, trading is your friend nonsense. They closed it and came down without you. Now you're trying to figure out the trend. You only realize it now, right? Because remember, and let's not lie to each other, a lot of retail traders are told to wait for confirmation. Another nonsensical thing that we don't do in the academy. What's confirmation? Confirmation in general, let's say for a bearish signal, let's say you want to sell something. Right? Confirmation is stuff like this. So you get a red candle leaving a resistance, right? Quote unquote resistance. You need momentum. You need to see that price is committed to selling. So 1, 2 will happen, right? Then maybe it's a bearish engulfing candle, maybe it's a shooting star, night, all that kind of crap. But the point is they are only going to wait for confirmation, which is, I guess, logically sounds like a good thing. And I'm not saying you shouldn't get confirmation. I'm just saying there's different types of confirmation. And this one always means the retail trader who is going to sell at the bottom of the yellow line. I'm teaching a lot tonight. Not good. At the bottom of the yellow line, right? It simply means they're selling late. Why? You always want to sell high. You want to sell where smart money is selling. You are now selling here. After all, because don't forget what smart money is going to do. 9 out of 10 times, you can see it in your charts all the time. If there's red candlesticks, there will likely be green candlesticks to follow all the time. This is the logic, right? This is literally them outsmarting you 10 out of 10, right? So they pump a little bit up back there. You take the buys for them. They have a pool, a market pool to sell to. And all of a sudden, wham, bam, you get that bearish engulfing candle. And it's big, it's red. And for most retail traders, that's the signal. Now it's time to sell. And what you don't understand is the moment of selling for smart money has long passed. They are just in profits now. Right? Literally, they're done. They're in profits. They're going to hold their position because what this picture has painted is retail traders are simply going to flock into this asset, flock, and push price down with their own money, not smart money's money. When smart money does the retracements later on, they are blowing retail traders without messing up profit margin. I hope that's enough. I want to move on from there. Now, so this is important because it tracks retracements. A reversal is the opposite. A reversal is the ending, right? It's the complete ending, reversal of a trend, reversal of a trend. So the trend is done. The bears are exhausted. It's a bullish market. The buyers have taken over, right? The buyers are flying. Now, what the fib does then is the fib tracks specifically retracements, not reversals. But not only does it do that, remember I said earlier on, it's a beautiful way of chopping up something holistically out of 100% into key specific percentages. And those percentages represent key areas, right? And non-key areas, okay? Non-key areas. And we use, and I hope you will one day learn to use the fib for two things. Number one, entries, naturally. But number two, also risk-based assessments. Right? And then number three, unfortunately, is not part of tonight's class because I have to walk you through order blocks. So if you take the module one part of the course, which is about 4 weeks, right? But that in itself, the main part of the tool is number three, which is to confirm order blocks, right? So this is what we kind of like do in the academy. We need that confirmation that this is an order because not all order blocks are equal. The banks will split money, capital. The first move here, you see here, where they sold for 20 bucks in this example, here they'll put 5 billion US dollars. They will go in because they're selling high. It's the highest price, the most premium sell point price. Every time Apple releases a new phone, a new iPhone, right? You know the iPhone device. Every time they do that, every single time, that product is worth more. Premium sell after premium sell. Logically, if you think about it, they are always diluting the market value of their product. Logically. What's wrong with the iPhone 6? Or why are we need the iPhone 7? What's wrong with the iPhone 7? Why do we now need an iPhone 8? Or what's wrong? And so forth and so forth. So you would think eventually that there'll be a market collapse, a saturation, right, of products in the markets to a point where markets need to de-link the value-based assessment of this product and give it a fair variance. Say, look, man, your iPhones are crap. They come in 10 different parts, earphones, battery, whatever, and you're constantly updating. Can't you produce a one good longevity product that I can put quality money on and hold? Why must I keep spending money, blah, blah, blah? But the retail trading psychology doesn't think like that. They see a shiny new uphill, they think it's a new thing, they jump in. And that's how Apple has been able to capitalize basic trading psychology or human consumer behavior, or what we call consumerism, right? So now, in this particular scenario, banks will put the most capital at the top, 5 billion bucks there, and then supplement it. Now, this 5 billion is going to make an extra 3 billion in profits. Remember this 3 here where we sold from 2017? I'm just using numbers just to make them relative. So at some point, you start off with 5 billion on the line. This is not your capital. This is the percentage you risked of your capital. I'm talking about big banks, right? And on top of that, you now have equity. Your profit margin has increased by, let's say, 3 billion. So what you do as a smart bank is you protect the 5 billion that you started off with, and you now use your equity to keep pushing a conviction move. So you're pushing a sell. And so that's now this 3 billion bucks that's holding this little pick here, right? So the order block is my point really with the fib and tracking order blocks is sometimes when we're using the fib, we have to also acknowledge the type of order blocks we are dealing with. 365 traders, I'm referring to things like Talitha areas versus peak supply. 365 candles versus value-based demands. Okay, just so you guys understand what I'm talking about, right? They're not equal. We spoke about this in our module 2, right? Not every area of value is equal in sensibility. This one we have 3 billion. So maybe if there is a market conversion, a bullish market conversion with enough conviction, with 5 billion, they can break that level because there are more buyers than sellers. Right? But if this 5 billion is compounded with the original 5%, 10%, 12% risk assessment, which is the 5 billion above, that means this area of value might hold because we have 8 billion. I hope that makes sense. I know when I start doing numbers, people get confused. The 8 billion comes from 5 plus 3. Basically, if they put in their risk area, moving your stop loss forward to lock profits, basically, then you're holding that key psychological area, right? Not important. Let's move on. The point is we use the fib to confirm these order blocks and in their different entirety, right? It's almost 6:30, so I should be moving to charts very soon, right? So now I'm going to remove all of this because I think I've done enough preparatory work. I'm going to show you how the tool is used, but what I've just said is very important because the tool is calculated and following these basic things. All right. Now, the fib, like I said, guys, is just a simple, beautiful thing that does a good job of breaking markets up. So let's just say the area of value, the swing. We're going to be talking about a swing high, swing low. In fact, let's start there. If I'm in an uptrend, so to use the Fibonacci correctly, you have to be very good at understanding the trends, right? Remember, on your trade view or your broker platform, whether you use these time frames or not is a different story. Most of the traders who come to the academy, most of the times, kind of like deal with a very specific approach to markets. They are always on 15 minutes, and I think they're trying to be day traders. Hi Rubizai, thank you so much. Hey Mr. Marks, good to have you on the Facebook seat. Thank you guys for watching on the Facebook Live, and to the other people there. You didn't comment, so I don't know who you are, but I appreciate that. Shake my hand. Right. So what was I saying? What was I saying? I was saying it's gone. It's coming back. It's gone. Right. Anyways, I think it was important. It was very important. What is it? Someone remind me. What was I saying before I started greeting people on Facebook? If you can pop it on the chat, that would be great. But oh yeah. Okay, I got it now. Swing high, swing low. You have to be able to identify trends. Right? In the market, there are several trends. Now, a lot of the retail traders will join us in the academy because they learn from other places first. And it's my job now to spend weeks with them trying to unlearn things and teach them new stuff. Is whether you like it or not, on your actual chart, on your broker platform, there is a logical reason why you have the monthly chart, weekly chart, daily chart, H4, H1, 30 minutes, 1 hour, 30 minutes, 15 minutes chart, 5 minutes, then the 1 minute. It's not, guys, it's not decoration. I can confirm with you that anything from about 1 hour time frame, which is here, you are most likely to start to experience different trends. And those trends will have different time limitations on them. Some trends will work very well with other trends, and some trends will last longer, some trends will not last long, but eventually market will it will fall into a state of equilibrium, like a state of normlessness, normfulness. Actually, equilibrium is a state of norms, right? To normalize. At some point, whether you've gone to sleep or whatever, at some point, the 1 minute chart will align with 5 minutes, and the 5 minutes will align with 15, and the 15 with 30 in 1 hour, all the way to the monthly. We call this the golden thread, right? And that's like a very long, complicated thing we do with you at the end of module 1, the last week of module 1 of the actual course. There's a golden thread. But around this golden thread, ladies and gentlemen, is a lot of zigzagging of different trends. Now, for the fib to work, or for you to be able to use the fib appropriately, you got to be able to identify the true trend. You have to know, like, the true trend is gonna be affected by several things. For example, what kind of a trader are you? If you're a day trader, you've got an interesting job, because you're not looking at the global long-term perspective of markets. You don't care where markets will be in 2 weeks from now. That's too far from you. You care about the market right now. Mr. Ralph, I saw your question on the education group about the time frames. Last night after the Zoom, we spoke about the right time to take day trades. What's the right time? When is there much liquidity? I will respond in the WhatsApp group tonight. I have posted it before in our particular group, but I'll do that. So now for a day trader has to be aware of the thing I just spoke about now. When a market's liquid, not only that, in your smaller time frames, what is the governing trend? Right, and I type like this because of this guy. See this guy here? I'm highly neurotic. So my mind thinks a little bit faster than I talk. So sometimes when I type, it slows me down so I can communicate clearly. I type so that I can actually like catch my thoughts. Okay, so if this bothers you, this is really how I teach all the time. Sometimes it actually helps a lot of people to get notes as well, but this is how I operate, right? For those of you who don't know me, right? So now, but the swing trader has a different trend that they're looking for, because you're going to be swinging into the market for a couple of weeks, if not months. And so for a swing trader, you got to know the overall picture of what the banks are doing. Which banks? Well, you have to look at your clientele. If you're looking at GBP, USD, what's the Bank of England thinking? Is it Bank of England bullish? Is it bearish? If it's bullish or bearish, is it in a hawkish state? Has it got a risk on sentiment? All the stuff I spoke about in the war room last night, right? It comes together. You don't have to memorize it, but it will come together. And you do all of this using market structure. That's my approach. I don't do a crazy fundamental analysis. I understand fundamentals because I love what I do. I love my field. Like there's nothing about markets that I don't ever want to know. And I'm in a blessed position. I'm still quite young. I just turned 30. So if they introduce something, I'm going to be obsessed about it. We just pulled out new PhDs. Was it last year? We did some funny challenge. We got people on core metals like iron ore. Like I want to understand every single market. But I'm saying to you, you will get all of this by your candlesticks. Not candlesticks reading. I'm talking about your charts. Just looking at the charts, all this information is there. So what the fib does, depending on what trend you think you're looking at, depending on what time frame and the type of trader you are, what the Fibonacci will do is the Fibonacci will take that area of values, right? Basically, the chart. So let's say it's a downtrend, right? You'll get something like this in a downtrend, right? So it will take this area here like that and break it now into a couple of parts, break it into the hundreds, the 100 components, and they're the fib levels that I generally care about, which I want to talk to you about tonight before it's, okay, I still got 30 minutes before 7 p.m., right? And we've done like an hour, 30 minutes together, which I think is fair. I'm happy to push further. You can ask my students. Some of our classes I go on for 3 hours. Yeah, but I mean, most of you are probably like got data issues, or you want to go, or whatever it is. So I won't talk forever, right? But what the fib will do, depending on where you place it, it will start to break down the market structure in percentage size. It will give you pockets, and guys, those pockets are future testing. Basically, they are future testing the potential psychological area. I'm just going to put a P there, right? Psychological area for a repeat for smart money. If smart money is selling, like in the previous example that I showed you, they sell at the top, they're going to pump, buy, and sell again. Pump, buy, and sell again. That's all they're going to do until they are done with the trend. The trend is really being run by what the central bank of those economies is trying to do for geopolitical reasons. There is nothing more, nothing less. If they want the dollar to be strong, they'll make it strong. If they want it to be weak, they'll print money. It's called monetary policy, interest rates, all those things when they just jump. Tomorrow there's news about interest rate. It's called monetary policy, and I'm tweaking my economy. I know what I'm doing. I know what I'm doing for my country, number one, and it's going to affect how I relate with other countries. AUD, NZD, if you check on the Telegram group, if you're in our Telegram group, people are in profits, right? Because I told you guys, risk on sentiment, but they increased their interest rates. GBP, USD, very bullish. They ruled out negative interest rates. They're trying to stimulate in a different way. If you check in the United States, FOMC will take forever to do these things because they're dovish. They keep printing money, they keep diluting the dollar. You are trading that psychology, right? You're not trading candlesticks because, oh my God, there's a hammer and a bearish harami and a shooting star. Nonsense, all right? And I'm happy to debate with you on the comments, just not right now. Absolute nonsense. It's a $5 trillion making machine per day. It's not going to be put in the randomness of people who did a course in baby pips, right? This is literally the heartbeat of the economy. Now, what the Fibonacci will do then, given the area you've given it to operate in, it is going to chop it up into a logical assessment of what the most 100% or closest to 100% likelihood of retracement areas. Now, I would like to quickly switch over to my chart, so we can like really start to do this thing practically, right? But maybe before we do that real quick, let me just tell you how to use the tool. Then we can then do a practical. As usual, guys, if you're watching on Facebook, I just really need to know if this is a good use of time. I took a lot of walks today with my partner, and then walked the dog, then walked my mother-in-law, and then we took a drive. Like I've just said, a very relaxing day, to be honest with you. So I'm just saying, if this is a good use of my time, just like the videos or just let me know, so that I keep doing this kind of stuff because I enjoy it. But I'm about to start teaching in February anyways, right? So my course is about to start. But two things about the fib. Last thing on the whiteboard that you need to know. Number one, how to use it in a buy and how to use it in a sell. So let's say we're going to buy. So the first thing I'm going to do is a buy. How do you track a retracement in a buy? Remember, at the back of your mind, Leroy is talking about the tool. Leroy is not promoting a Fibonacci trading strategy because that does not exist in Leroy's world. Leroy knows at the end of the day, he's only going to buy at order blocks. Leroy is using the Fibonacci tool to confirm key order blocks, right? Cool. For a buy setup to happen, where I need to use my fib, I am going to need a retracement, which means I have already done my homework and I understand the trend. This is important because I don't like signals. I don't like running signals. I spent 2 years making fun of signals. Signals do two things to you. Number one, they cripple you. I understand people need money. It's Corona, it's COVID. That's why I'm doing it. And if you follow me from last year, November, I said I was going to charge for the service. So I'll say I'm going to definitely be charging you guys. So you guys make me work. And I decided to just remove the trading plan. So it's not too much stress for me. So if I just do the war room and I give you guys calls and it's free information, it's fine. If I start compiling my trading plan, it's like a lot of work, guys. It takes me like 6 hours to do that kind of stuff. Then I won't exploit myself. I'll have to charge you. I don't want to charge for signals. I'll give them for free just so you guys get into the habit of seeing profits and kind of like normalizing making money as a retail trader, right? So it's important, right, that you understand that for retracement to happen, you better best believe have read the trend correctly. So you've done your work. You know it's a buy, right? You're not crippled by a signal, because a signal service provider, whether it's me or someone else, we could be wrong. Number one. Number two, we could be looking at different time frames. You guys who pay for signals from different people you've never met, what time frames are they using? They don't tell you that stuff. I was on Telegram groups 2-3 years ago, just seeing whether I should launch 365 Trading Academy or not, just to see what was out there. There was nothing productive. You get an entry point, a stop loss, and a TP. What bloody time frame? Can your stop loss hold his area of value, the signal service provider? Because he might have $1,000 US, and you got $100 US, and his stop loss area value is 100 pips, and that's too expensive for you, maybe. Let's say you're doing trades on like gold. You know what I mean? So you need to be able, even if you're taking signals from some people, you got to have the basic tools, man. You got to like say, okay, I see what he's trying to say, but it doesn't make sense for my account. My account can't handle this move, so I don't take it. Because I'm going to give you signals one day that your account might not handle. Or I'm going to give you 15 signals at once. And you need to prioritize. Where do I get the biggest bang with the risk allocation that I have to do? You're a fund manager for your account. Let's move on. But basic maths, if you can't handle $10, you're never going to handle $100. If you can't handle $100, you're never going to handle $1,000. If you can't handle $1,000, you get the picture. All right. So trend correctly, retracement. So this is what it looks like. This is what you need to be looking for in your chart. If it's a buy trend, a going up trend, then a retracement obviously looks like it's coming down. There are key things that you need to see. Number one, you need to see what we call a swing low, swing high. You need that. You need that. A swing low, swing high. This is non-negotiable. Without the existence of both swing low, swing high, and a dump, right? A dump. 365 traders, I'm going to try and, make it a little bit newer. There's not really much I can do to spice it up, and I appreciate the actual students who asked me to redo this thing, but I'm just trying to make it a little bit so you're not too bored, right? You need a dump in that particular process. Now, this is what it looks like. This is what you're looking for. First of all, for a swing low to happen, price must have been coming down at a previous trend. Woo. Now, you could have been on the 50 minutes or the daily or the weekly, or it doesn't matter. But at a previous trend, price had to come down. 365 traders, this is like the hallmark of our value-based demand buy setup, right? Our module 2. The only buy we take in the market, if we're to gun to our head, we take value-based demand buys. And we know it starts like this. You need dumb retail traders selling into a key area of value with lots of money in an order block to shoot up. So once you figure that out, this is what's going to happen. Naturally, in an uptrend, smart money, once they see a pool of dumb sellers selling close to them, if I want to buy something, I want to buy a calculator, I need to go to someone who's selling a calculator. And that's what smart money is going to do. Wait for these guys to push the price down. Remember our green candlesticks? They open low, close high, and then smart money is going to pump it up. Boop, up it goes. Okay, you're going to get something like this, right? So obviously these lines represent candlesticks going up. So then an uptrend is formulated. Now you've got your uptrend going, and it's thanks to these down retail traders here most of the time, right? And then all of a sudden you get a dump. The first sighting of a dump, depending on your time frame, if you're on those smaller dangerous time frames like 5 minutes, 15 minutes, then you better be quick, because you don't want to catch this dump too far, right? You want to see 2-3 candles dumping like this. This is what I mean by swing high, swing low. Swing high, swing low. Guys, I'm sorry, I'm feeling very anxious. If you're in the Zoom, can you just type yes, this is making sense, or my pace is fine, or no? I'm paranoid. And if you're on Facebook, I'll quickly look over the Facebook in the comments. You guys with me? You guys good? If those of you watching on the live, I just need to know. Sure, bro, we like your channel. Kenneth, thank you so much, man. James, appreciate that. Guys, just let me know, please, as quickly as possible. Are you guys with me? Logically, Have I lost you guys? Is my pace okay? Oh, good, bro. Thanks a lot. Fine. Pace is fine. Thank you, Eunice. Abby, okay. Timothy, it's okay. Fantastic. All right, cool. And just one or two people on the Facebook Live, just so I know. Maybe I'll see the Facebook Live comments later. Right. Okay. So for the most part, I'm going to move on. Right. The consensus is people are rocking with me. You guys on point. Fantastic. Right. So there you go. I've got a swing low, swing high, and I've got a dump. I need those three things before I touch the fib. If one of these things is not in place, I'm not bothered. I'm not looking for a retracement. I hold my trade. Hopefully you understood where to buy and you bought on time, smart money rights, blah, 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 blah. But once this happens, it's now time for the Fibonacci. Because what you want to do is you want to track, right, this dump. Pump, dump, pump, dump. It's what cryptocurrency does. That's why the only thing that will ever be consistent in crypto is change, right? It's always going to be pumping and dumping, pumping. Maybe if there's time, I'll end this with the YouTube, not a YouTube, a Bitcoin chart. Miss swing low, swing high. So Bridget says she missed the swing low, swing high part. I appreciate that honesty. Thank you so much. Kenneth on Facebook saying pace is fine, and I got good stuff from Tania. Right, fantastic. Right, Bridget, real quick. This is the swing low, swing high. This S that I've kind of like drawn. That there is the swing low. So this is the low point right there, right? And then price rallied all the way up and then started to dump. As it was dumping, it created a swing high. You see up there. So these 2 points, I need them. Right? And I need them based on that structure. Does that make sense? So this is my swing low is here. Remember, look at this. I'm swinging. Whoop, I swung from the low. And then my swing high, I'm going to swing downwards from the high. Does that make sense now, Bridget? Real quick, just let me know. I'd really genuinely never move on in any class until I know everyone is with me. Fantastic. All right, cool. Everyone is perfectly fine there. Right. So I've got these two things in place. I know my trend. I finally have the confirmation of a retracement. That confirmation came from a swing low, swing high, and a dump. We're talking about a buy-based trend. Then I pull out my Fibonacci tool, right? And we're going to do that on the charts. Let's talk about a sell real quick. Bada-doom, sell. Now, a sell, guys, a sell is, the logic is the same, but the setup is slightly different. But again, if I'm looking for, so smart money sells, and all of a sudden it starts to pump a little bit, and I want to jump into the next sell with the best logic where I can, right? I'm going to go through a sell retracement. First of all, I have to be sure that it's a sell, right? So I need to be very good at reading my institutional order blocks. I cannot overemphasize this. Thing falls apart immediately when you don't have that institutional knowledge. Because if you're mirroring this with support and resistance, you're going to get mixed results. Sometimes it'll work, sometimes it won't. It'll work when it's aligned with the institutions, but it's never, most of the times, 80 to 70% of the time, it's not. So you need to know the correct trend, and it's going to be based on the type of trader you are, based on the time frame, blah, blah, blah. And then naturally, again, like I said earlier on, and my God, I have so much fun when I do these free classes and my actual course. I have fun when I teach markets. I don't know why, man. I don't know why. I'm slowly starting to think it's just my purpose, you know. What I'm saying is I'm pumped, and when I get pumped a lot in class, sometimes I start to talk a little bit fast, right? Because I'm excited, right? So you're gonna get the swing low, swing high dump, but it's gonna look like this in a sell trade. In a sell trade, I want to sell high because sellers, the red candlestick starts at the top, sell high. That's the logic of any bear in the market. Bears, bearish sellers, all right? But I'm talking about smart money. So I'm going to see something like this. If I want to sell high, there has to be a pump. Pump up first, naturally, right? 365 traders, to my in-house students, I hope, because I'm doing it a little bit differently like this, that this will help you. I really hope it will help you like a little bit differently, because I know someone in the class did ask me. So all these public classes, guys, you really need to thank all the 365 students, because these are questions that they gave me, and these are the ideas that gave birth to these public lectures, all right? So it's to them that we're doing this. Anything that those students want, especially group 20, I want group 20 to grow now. Right, so anyways, so I've got this pump in, and then the sell trend continues. So now I need a swing. All of a sudden, this happens. Boop, right? All of a sudden, prices going a little bit up now. This swing high and the swing low here. You understand it? These two swings. I don't know if I messed them up, but the point is these swings where prices was going up and started to go down and was down and started to go up. And here we have the opposite, right? Down, up, down, right? This swing here then qualifies us to start looking for a retracement if the trend hasn't come to an end. So this is if we are not dealing, remember, with the market reversal, and I can teach you how to identify market reversals. It comes from a higher understanding of that golden thread, those time frames I was telling you about, and how to use them. So we do a lot of that in the academy first. In fact, no one is allowed to kind of like talk about a chat or even post a chat in the group or rethink a chat without considering what kind of trend we're going. So there's a specific chart we call our governing chart that dictates the principles of price throughout all time frames, right? So this is strictly for a retracement, right? Not a reversal. Now, if you guys don't mind, I'm going to quickly flip now to the charts. If there's a specific chart you want me to do, I'm happy to do it. Otherwise, I can just play tic-tac-toe and choose a random chart, right? No question on the Facebook Live. I'm really good today. Like I'm actually checking live on time. Fantastic. Swing high, swing low, dump. Haven't you mixed it up? Yes, I did, and I did say that. So thank you for catching that out, Bridget. You're very correct. But the concept is the same. Pound USD. Pound USD. All right, cool, man. You guys watching the war room yesterday, like a lot, yeah, we spoke about that chart and it's literally doing what I said. I mean, like I say to you guys, in full disclosure, I already had a position in pound USD at the bottom. So I just went in 1%. No, I went in, I think it was like 2%, 1.8% of equity made, not even of my capital at that particular level, because I categorize it as a class C trade, and that's because I want to buy lower, right? I'm always thinking of how would smart money kind of like view this whole thing, or what would smart money do? Would smart money invest money there? And if they did, how much of it? Because if my money is not aligned with the best order block, right, then I run the risk. But there we go. Literally, guys, like if you attended the war room yesterday, this is literally from yesterday. I love what I do. Been right in the market 9 out of 10 times because 90% of retail traders lose money. Anytime you're right, you are part of the top 10% that are actually making accurate market calls. Now, if you couple that with the powerful, or at least a moderately powerful trading psychology mindset to hold such trades, I told you it was going to come up to this yellow line. It's about 80 something pips. Then you're golden. Like it's you can see that I've been marking these trends. I've been taking my positions carefully, etc., etc. So for those of you who made money on this trade from literally yesterday's war room, well done on you. I guess well done on you for trusting me, because I think I did a lot of the work. And then gold. All right, cool. So we've got two charts. We've got pound USD and gold. All right, I'll do those two just because of time. Right, I'm not doing trade calls tonight. I'm just helping you understand how we use the Fibonacci. Fantastic, right? So I'm going to quickly go to a different broker so that I don't remove all my lines and all the stuff that's there. And more importantly, we won't be able to read my Fibonacci's properly on top of all those notes, right? So I'm going to pull out exactly the same chart, pound USD, but I never want to mess up my analysis. So this is fine. I normally teach on the Saxo broker thing, right? So this is the pound USD on the H4 time frame. Right, so I'm a different kind of trader. I'm a swing trader. Excuse me. Because I'm a swing trader, I don't like small time frames. They're very noisy. They are congested. I found I used to overtrade a lot on smaller time frames. And when I overtrade a lot for my profession, so like remember, I'm not just like this. I just teach people at night. I literally do this, the corporate side of trading, during the day. It messed up my statistics because to make the same amount of quantity volume trades from a day trader perspective, I trade far less in swing trades, like almost 2/3 less than I used to on my day trades, and I accumulate way more because once I find the correct place, I'm just patient. But remember, this is me now 8 years later into the game. Some of you might need money tomorrow, might need money next week. So you are all approaching markets from a different point of view. So some of you might need to be day traders. You might need to clock in 20 to 60 to 80 to 100 pips every 2 to 3 days so that by the end of the month you can make rent. That's how I started trading. It was horrible for my trading psychology. I can call my partner here. We went, my story is filled with misery from how I started, right? It's not, that's kind of like why I didn't have anyone doing this. That's why I'm doing this for you. No, it was difficult. Trading courses 8 years ago ranged from 20,000 rands to 25,000 rands, the good ones, because they were still trying to pump the market. Sorry. So anywhere between $1,200 to kind of like $3,000. If I look at my certificates up here on my wall so that I can't flip my webcam, institutional trading portfolio management, which I got 2 years ago, was $3,000. I had to pay that. The CFT level 1, CFT level 2 with IFTA were both $1,250 each. And then I did the South African Institutional Financial Markets Regulation course, which is about, in total, about $1,000. And then Online Trading Academy, which was $7,000, which took me like a while to get through, right? So it's a lot of compound. And then I joined other smaller groups. So there was no one really, except for one group in South Africa, that primary supply and demand traders. So I think I paid, I don't know, it was 3,500 rands. So it wasn't that much, maybe $500 or something like that, or 300. I can't recall. But the point is, it was a difficult journey. So it's a fun, long story. It's not in the book. The book I wrote right now is just this rule-based trading approach. Maybe the second book, I can walk you through, the psychological part of trading. But anyway, I'm a swing trader. Sorry to kind of like, digress. So because of that, my time frames matter a lot to me. I have to see the bigger picture. And I'm looking at pound USD, and let me see if I've shared my screen. I've shared my screen, right? So I'm looking at pound USD here on the bigger picture. This is a weekly time frame, to say the least, right? And I'm not convinced at all that I'm in a downtrend. In fact, there's so many things. I can see broken bearish order blocks. I can see power moves. Remember, we spoke about the risk on sentiment last night from the 3rd of November. We've been risk on since this big candlestick, which tracks us all the way back to COVID. And then we got a much more risk on another candlestick. Where is it now? There we go. 2nd, 3rd of November, Biden run, right? Which gave us a boost, right? So we've been very risk on. As long as there was a dollar backing, the dollar was falling since March. The dollar's been falling since March. Pound has been doing exceptionally well. In fact, it was last week where pound was the strongest currency, and the week before it was the euro, right? So I am, as a swing trader, aware that I'm in a bullish trend. You see what I just did? I'm in a bullish trend. So when I am looking to use a Fibonacci, remember, you guys asked me for these charts. It doesn't mean these charts might qualify, because for it to qualify, I need this setup. I need a swing low, swing high. I need a dump, right? So right now, okay, we might have to work on this chart. We might have to work on a historical level because it's very key that we understand it. Speaking of the book, have you sent it out yet? If so, I haven't got in mind. Abby, which book are you referring to? Are you referring to Happy Money? Because if you're referring to Happy Money, this is the book I promised to buy everyone who asked for it a long time ago. I've sent this out. And I know you're not in the WhatsApp group anymore, but you're still in the remote course, Abby. I literally added you on the remote course. If you're talking about Happy Money, just check in the resource folder of the remote access course. Happy Money is in there. I put out the announcement in all the education groups, but you probably didn't get it because you left the group a while back. I'm not so sure if you changed your number or what. But if you're talking about my book, right, the 365 Traders Trading Manual, my book hits South African bookstores on the 14th of February as a Valentine's gift to every single trader out there. So my book only comes out mid-February. So just clarify which book you're referring to, okay? And if it's the Happy Money book that I promised to send, it's already out. I've already bought it for everyone. I bought a copy for the Academy as well. and I sent that out. Mine, okay, so mine comes out in Feb. So you'll get it in Feb. I promise. Cool, right? So I need to see my swings here. Number one, Mr. Timothy and whoever else is interested. And I can't see them yet because right now markets is pumping, right? So here is what I was telling you guys about. There's part A and part B, but part C is not yet there. You see this? Remember I said first you're going to have a dump sellers sell into an area of value where smart money is going to buy. Bullish trend. So now I need a dump. When I finally get a dump in the scenario, I'll be able to pull my fib. But that's not, a problem. Let's back test this actual chart and find out a moment in time where we did get, a similar setup. 365 traders, if I scroll fast enough and you actually see an area, just help me catch it with my eyes. Let me know where we want to continue selling and buying. Right, so that's not clean. And after this point here, October 16 going backwards, everything else is a downtrend. So we wouldn't be looking for a buy trend. So I'm just going to flip to the daily chart maybe so I can find something useful there. Let's see if we can find something useful there. Right. So there we go. Mr. I think it was Timothy, but anyways, everyone who's listening. Right. So I'm gonna quickly illustrate something. You see this here? I get that momentum that I was talking about. Then I get a push, right? There could have been an interruption here. Could have been an order block, it could have been to the area. It's not important, right? But it does happen here. This is a key thing later on. Okay, number one. Number two, when I'm marking my fib, I always have to use the most recent swing. So let's quickly do this. Replay. Gotta love TradeView. There, just like that. Boom. So today is the 26th of January, ladies and gentlemen, and this is where the market is. That's what you're going to tell yourself, right? I know that we've cut other charts out, but this is where the market is. The market does something like this. Number one, it dumps, gives us a swing here. See that? And then it continues up with the uptrend and then starts to dump again. Here we're at a sideways movement. Just be very careful about this. I'm seeing consolidation. I'm seeing a moment of quick accumulation. I'm not seeing a dump. A dump is literally a dump, like they start to sell off, right? So, messed it up. Now I plot my fib, which is finally the whole point of the class, Fibonacci 2. Right now, the fib, guys, always draw it wick to wick, not body to body. And I know there's so much information on YouTube, baby pips, forex guru, Nasdaq killer thriller Nasdaq, blah, blah, blah. Doesn't matter who they are. If you want to rock with the 365 way, use the wicks. For an up trend, for a retracement that's gonna go up, right? Here, it means I have to draw my fib bottom to the low going up, okay? For my particular uptrend. If it's a downtrend, I have to pull my Fibonacci from the top going down. So the best way to remember it is you always draw the Fibonacci in the direction of the trend. So if I'm in an uptrend, I must find the low and then I must go up. And if I'm in a downtrend, people are in the war room and in the Telegram group while we're in class. I guess there's a chat going on there, right? So and if I'm selling and I take out my fib, I have to push my Fibonacci down, right? So here's the fib here. And we've identified this as an uptrend, right? It's an uptrend. There's Ms. Hafeni trying to enter the room. So I'm going to pull it here from this wick here. And I'm going to pull it all the way up there, like that, right? Now, this is quite interesting. Actually, I love this. 365 traders, remember the rules. We don't have an order block, but we've got our areas of value. We've got our areas of accumulation of value. We don't have an order block in those areas. We might have one on the H4 time frame. And then you kind of like have to do screen. I'm not sharing my screen. Sorry about that. Thank you for that. Right. So let me just redo that because you probably missed it then. A couple of people entering the room now. Right. So I'm saying I'm going to plot my Fibonacci. Then I'm going to capture this bottom area of the wick there. then I'm going to pull it all the way to the top, right? So wick to wick, and then I'm going to, because this is happening right now today, so I'm catching the down, and I'm trying to track where it's going to retrace. Now, fundamentally, when it comes to the fib for smart money, we like to use the 61.8%, which is what we call our golden ratio. Okay, smart money loves a 61% retracement because remember, you're buying something. So if you bought it down here, just work with the logic. If you bought it down here at $6, at $1, let's just say $1, and then you push it all the way up, right, to somewhere here. And I apologize about the noise in the background. Right, so you push this thing all the way up. So you bought it at $1, it pumped to $10. Smart money doesn't want to rebuy it at $10. That's not buying low. They have a preference of catching this thing at a 61% discount. So if you can get this asset to come all the way down somewhere here, right? Somewhere here, it makes more sense to them. This area here, this is better for them because then you can rebuy the same asset at a cheaper price and pump it up again. Does that make sense? 365 traders, this is new to you, kinda, a little bit. I talk about it all the time, but I'm just gonna add something because remember, you guys are, a lot of you have done my module 1, module 2, so this year you're qualifying for my module 3, the intraday trader course. A day trader, and I know Eunice is rubbing her hands somewhere, right? A day trader, guys, for the intraday trader timeframes and the perspective of a day trader is you cannot ignore retail traders. Right? You cannot ignore retail traders. You can't ignore people in the markets who don't know what they're doing, because don't forget, they're putting their hard-earned money and making losses, but they're also pumping money in specific directions. I see there's a question there, if I can get it. Okay, it's Eunice. Eunice is saying very alert. Fantastic, Eunice. So here's one of the gems, right? The jewels, right? So you can't ignore retail trader levels, because remember, for a day trader, your volume is in hours. You're looking at that London session between open and close and how it's going to intersect with maybe the New York session. But in that time frame of volumes, right, all you have is that little time. And so there's retail trader, there is smart money. Both those things are clashing. So when you use a Fibonacci, right, and I want the entire academy to start to kind of like think around these things, I would advise you also to stay, pay particular attention, please, to the retail trader level. The retail trader level is not the golden ratio. It's just a retail trader, because a lot of the times support or resistance will coincide at that level at 50%, right? You're going to have a 50% area here, and I'll show you what I mean. You see here? There's 50% right at the top. They say 0.50, and this is the 61% I'm referring to. So moving forward, I want this to be your golden ratio area, and I'm going to show you how we're going to do it. The easiest way to do this, and I'm going to go back now to the whiteboard because it's very important, is you're going to have to think like a fund manager. That's how you trade. You're a fund manager for your account. Now, my brothers and sisters, let's say you got $200, $100 to $200, because that's what most respectable brokers start you off with. If you have a broker who made you start an account with $20 and offered you a bonus, I want you to know your broker is poorly regulated. It's not a good broker, but that's neither here nor there. Right, so let's say you got $100 in your account, 100 to 200 US dollars in your account. You've got a buy trend on pound USD. Okay, that's number one. And in that buy trend for pound USD, you're trying to catch a retracement. At the 50% level, you are going to have to split your capital. And it's going to be tough, right? Because the US got that rule of 0.01%, which represents about 5% of every 100 US dollars in your account, which if you do the math is actually $5. You're spending $5 on an area. And if you do the math, because you're a trader, you know that pips is how we make money. And if you look at the basic pip value of Euro USD, it's about 0.10 cents per pip, right? So that's how I got those calculations. You just do the math, you work it out. Most of our areas of value in the academy will be about 100 pips. And that's not a problem if we're using the right lot size, okay? Quick maths there. Now, 50% of your risk allocation in this retracement, if you got the trend right, must be put at, so you put a pending order, right, at that 50% mark, because you know that retail traders might actually have the conviction to organize enough money to park it there to a point where they might actually pump price up a little bit before institutional money takes it up. So you want to be in that action. And then the other 50% of your capital, right, which is really what I'm asking you to do, is to double split, right? So I'm saying here, you're going to have 2.5%. There's another question on the chat. Apologies. Oh, no. Shame, Hafeni, not a problem. You're a 365 student. I'll send you the video, okay? Don't worry. Good to have you, though, Dr. Hafeni. Good to have you. Sorry, guys. I got a private message from Hafeni. Right, so what did I say? Right, so 50%, what I'm saying here is you're actually splitting 2.5% risk. You understand? 0.01 is 5%. So you put 2.5% at 50%, and you put another 2.5% at 50 at the 6.18% area. I spoke fast. I'm hoping this is clear. All right. So you got two pending orders. Logically, this will work better if you have a 200 USD account and up, because then you can say 0.01 at that 50% retracement level, and then you can have plus 0.01 at that 6.18%. And what markets do a lot of the time is they put their bum, the candlestick closes on the 50%, and then they wick. They trigger you in with a wick on the 6.18%. We don't know if it's going to happen in this particular chart, but a lot of the time this happens. I hope this little maths made sense, because it's very important. You want to catch a retracement via pending orders, not market execution, right? It's expensive. It's not. Your trading psychology is off. You're trading off FOMO, blah, 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 right? So I'm going to go back to my chart now. Right. So now let's just see what happened. I would like to say, full disclosure, not any of my students in the academy would be eager to take this trade on the daily time frame because of there isn't an order block, right? Maybe if we use our black dots, maybe we can see something there. All right, so there is one on the 6.18. So there's a black dot there. So that's perfectly fine. But for the rest of them, most of the times we wouldn't have, right? If you haven't done the course or to understand what this, I can't even remove this highlighter. How do you remove this highlighter? Right, great, fantastic. Right, so don't forget, we're looking at what's going to happen at this level, 50%, right? Here, that's number one. And number two, what's going to happen at 0.168? And you've got a pending order here, you've got a pending order here, and together, hopefully you're smart enough to split your risks, it's 5%. Now, I don't know what's going to happen in this thing. I'm very interested to see if it plays out or not. Where's the play? Where's the play? No. Where's the play? How do I get my relate? There we go. Right, so let's play this. Whoa. That was so quick, man. And we're already encountering some technical problems. Right, let's cut this out a little bit. I apologize for that. We'll find it real quick. So this is where we are. I'm going to do a replay value somewhere there. Right, and then I'm going to slow down the speed. Right, so you see where I've posted the charts? We are already in that 50% area, retail trader value. And I've told you in the academy, we have a tendency to go for smart money. We only go for the golden ratio. But if there's a need, if you're a day trader, to always know where retail traders are going to put money, because you want to know how smart money, remember, smart money is going to screw over retail trader money to create a market for itself. Does that make sense? Right. So we're watching this area. So price retraces a sharp fall, bang, 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 into that 50% retracement, right? And if you look carefully at that 50% retracement, yeah, and you know them. They love their support and resistance. You see this here? You see this? Price was supported, and then price faked out, and then price was supported, blah, blah, blah. Right? So there's a little bit of stuff on the left going on there to kind of like validate this whole thing. Let me press play again. Hopefully the speed is a little bit slower. Make it slow. There we go. Let's see what actually happens. Pause. Can everyone see that clearly? See this? What markets did on the 50%, they give you this candlestick, looks like a weird hammer, right? In the academy, never mind, but anyways, it's happening, right? So they breached the 50% area, which, just to make painfully clear for you, because it's something I didn't tell you, there's nothing wrong with price playing inside this area. This is your whole 50% retracement. So the red line I'm about to put would be where your stop loss was. Let's make this red. So there's nothing wrong. If price goes in deep, it's fine. It's still part of it's part of the plan. But what you want to see most of the time is a retail trader. And guys, you can go on YouTube now and look at, Fibonacci videos. Most of them will tell you to buy at 50%. Most of them will, right? But that doesn't happen. In fact, price acknowledges that there's an area of trading psychological value there, but it's not worth much. That's what. So you get a rejection in this area. Price pumps up a little bit, and then smart money comes back, takes that pull. So they create a small buying market, and then they sell to them hard, right? They sell in them. That's their stop loss gone. Now, and then on this part here. And again, I really want to emphasize, not a single, you can ask them, they're all on chat. Not a single 365 trader would have taken this as a level, because Fibonacci is just a tool. We can track. I'm going to remove the 50% area now because we know it did not work, right? This is now the 0.618. This whole area is 0.618. So your stop loss here is outside. Now my computer is freezing. But in the academy, if there's no order block on the left, they know well, they would not have taken that. So just under this wick there is our stop loss, right? So there we are, the 0.618, press play. I'm looking at the time. If you have to go, I understand. Sorry, it's late. I'm just going to go for another 15 minutes so I can wrap this up. But if you have to leave on Facebook, on the Zoom meetings, I appreciate you for coming, but I would like to finish this so I don't have to repeat the class. After I press play, someone literally just registered now. Oh my God. Right, so what's going on here? So price has found a seating. You see that? Pause. So every time I see this, I get excited because markets haven't changed, guys. For almost since the Great Depression, since 1935. And my argument to you is, if you can master this stuff, you're solid. So there we go. There's my golden ratio. I've understood that prices come down now to some type of retracement, right? A solid retracement. You see this here? You see this here? Percentage wise? Let me do this thing. See this? Look at this drop, 61 pips, 600, whatever. Look at the percentage rate. Prices dropped significantly. And in my fib calculation, this level is a 61% drop, right? So smart money is now ready to buy. It's attractive. And I'm using the tool to know where to place my pending order, right? So there you go. You're in it. You put your pending order there on top of your 6.18 area. I apologize. I don't know if you guys can hear the ruckus. My dogs are going crazy. There were people talking earlier on. Sorry for all of that. Hope you guys didn't around. Let's make this purple so you guys can see it carefully. So this is literally my pending order, right? Sometimes we go on the H4 time frame. If I put this there and I go to H4, I'll show you right now. I'm pretty sure we'd have an order block. I'm hoping we'd have an order block, because if there's an order block on the H4, then a 365 trader would have been in there and there. There you go, right? So we know what we're doing. So it's like a complicated thing, but there is an order block. 365 traders can confirm in the chat, right? So long story short, there we are on the back on the daily time frame. Price finds a place to sit, and it's inside my golden ratio. Any retail trader who was trading that support, remember we look for support on the left, got their stop loss hit. That's rule number one. They're out of the game. They created a pool of buyers, sold to them, push price lower, and there they are. Now, this push that you're looking at from wick to wick there is 235 pips. 235 pips. You've got that 5% at risk. You got your 2.5 here just in case you're holding it, and you got your 2.5 down here, and there's your stop loss, right? Or naturally, stop loss is outside because 2.5 plus 2.5 plus 5%. Outside this area of value, and you have gained 235 pips right there. 365 traders, generally speaking, if you're a day trader, Eunice, this is a bearish candle, this was a PCP moment, you would probably take profits now on the smaller time frames. So on the 15 minutes or to 1 hour, this is a long run. That's why it's a lot of pips, or 235 pips. I don't know if it's a lot to you, but this is a good run of price, right? From the time price got here, the zigzag motion all the way up to where it is now. So good is you've got a lot of higher highs along the way, like structure is starting to change, but it breaks somewhere here. And this is now part of the module 3 course that we'll do later on. But the important part is for any trade of mine, they know the power of engulfing candles. You've got a bearish engulfing candle. You've got a PCP, this green candle that's breaking a trend. You take profits, 235 pips, a lot of money, depending on your account size and your lot size. Let's just see what happens after that. Does price come back down? Does price continue? I don't know. I'm going to press play. Right. There we go. So we get a rejection, right? This is the one I was warning you about. Immediately, right? Because of this on the left. It's working out so far. And then price comes back and hits that same area. Goes a little bit lower. Whoa. There's someone on the speaker. Yes, go ahead. Is that a question? I'm gonna mute you. Sorry, I'm just. Mr. Timothy, is that a question? Okay, just let me know in the chat.
No,
Sorry. No. All right. Cool. I'm just gonna mute everyone. If you've got questions, just type them in the chat box, guys. Right, guys. I know it's getting late, so maybe people's concentration spans are dwindling. It's a mistake. Not a problem, Mr. Timothy. Not a problem, buddy. Not a problem. Right. So look there. Price, you make your 235 pips, you don't get out, price comes back and it's looking for you, right? I'm gonna just remove this line there. There's our stop loss there, red line under this wick, right? To cover this area, because see, this is the new level, right? We'll talk about this level another time. 0.786 is where we barcode in the academy. So we put a lot of lot sizes because that's a massive retracement. Price is actually trying to retest the swing low, okay? But it's a different topic. Let's see if stop loss would get hit or if it wouldn't. I don't know. I'm just going to increase the speed now because of time. Price is maintaining that golden ratio, fighting for its life. Bears versus bulls. Now, as a swing trader on the daily time frame, I probably would not have taken profits there as a swing trader. As a day trader, I understand why. As a swing trader, I know that price has lost 61.8% of its value. So I know that the Bank of England needs to get that back. And I know my job as a swing trader is to be hella patient and to enjoy the ride, right? So if my stop loss isn't hit, I don't move psychologically. If you're a day trader, you're gonna have to come out here, rebuy there, come out there, rebuy there, come out up top, rebuy there, and accumulate as you go. And that's why I say day traders open more positions than swing traders most of the times, because they have to be in and out of an ongoing trend. Remember what I said at the beginning. If I know I'm in an uptrend, I ain't budging as a swing trader. Look at where price is now. Now this is a daily time frame. So we entered somewhere on the 11th of September. Price is basically heading back to its old highs, right? This is where my TP would be. So I took the buy in the scenario. I mean, oh no, let me quickly put that back right. So I took the buy in the scenario down here, if you recall, 11 September, price hits my TP 23 November. So it was a 4-week trade, but pause. It's a 4-week trade, but the day trader that made 230 pips here, hopefully kept them, right? Hopefully kept all of them and added in from my entry point to my TP point, I get 610 pips. Now it's a different ball game in the academy. If you learn how many order blocks were there? There was 1, 2, 3, engulfing candle, 4, 5, retested, 6. I would have put in 6 positions along the way in my Fibonacci level, right? The last thing I want you to see is how price danced here. Okay, guys, I know time is tight, so I'm in a slight panic. I'm rushing. Good clarification between the dynamics of Thank you, Mrs. Mtunzi. Fantastic. All right, cool. Right. So the day trader is in and out. I'm holding because my job is to accumulate. And remember, as a swing trader, once price clears this difficult, oh man, you know, I'm gonna start selling tickets to these things real quick, guys. Can I show you the last thing? If price clears the very first rejection that I got in my fib was here. You guys remember this, right? It rejected here. If price breaks this thing, and this goes to Mr. Mark's question, Ronald, your question about, you know, man, look at this. You made profits, then you lost them, right? And et cetera, et cetera, et cetera. And I'm going to do a class around that kind of stuff, Mr. Marks, but just to say, if price comes back to break this area of rejection, let's call it that, right? I'm not going to use the term resistance because, you know, I hate those words because they really create a misconception of markets. There, if price comes back to break this area up here, actually up there. Hey, what's going on? What's going on? What's going on? See, this is what happens with my mind. There we go. So I'm going to make this yellow. Why am I saying break? Because my first rejection was here, right? Remember, price came, rejected, and dropped. So if price ever dares to break this area of value here, I'm going to mark this yellow. I automatically now know that I am right about my trend and price wants to go up, right? There's a long concept behind that there's no time to explain anymore tonight. So what I'll do now as a swing trader is to wait for a new order block. I'll have to identify a new order block as price is going up. So I'm trading other assets. Remember, I'm done here. I'm making money. My $100 is growing every day using the equity accumulation process. I'm now on gold. We're gonna go quickly look at gold, and we're gonna look at gold, and we're gonna look for a sell, so we can do a sell Fibonacci level, right? So now there I am in another chart and other charts while this thing is doing. One day when I noticed that price did this, came into my area of value, rejected, went down, stayed in my golden ratio, broke it, right? Price must come back down. Remember in the whiteboard, I said markets move in zigzags. Remember I drew this for you, zigzags. Now here's an uptrend, boom, comes up there, massive engulfing candle, comes back down. When it comes back down to my 6,18, which is where we are, if you're a good trader and a smart trader, number one, you're adding to your position here. That's number one. Because again, you know where the trend is going. That's number one. So you've got trade one, trade two, trade three. Number two, once momentum kicks in, the zigzag is done. And price, sorry, come on. I was going to get a brush. I know the chart is getting messy. I can't even imagine what it looks like if you're watching this on a phone. And price moves above this high right there, right? Once that happens for me, as I track my swing trade, as I start to manage my account, I take my stop loss for my 2.5% at that 50% level, my 2.5% at this golden ratio level, right? My stop loss level, and then I push it, because now I've also opened a new position here, depending, I don't know, and I push my stop loss all the way up there to lock profits. Because what's going to happen is this confirmation of a break beyond the 0.50%, which is right here, 6.1% right here, means the uptrend is going to continue. And now I used to have $100, maybe I have 300 or 400 now. I don't know, you do the math, right? But price is going to continuously zigzag all the way up, pump and then sell for a cheaper price, and then pump again and then sell down, and then pump again and then sell down. I hope that makes sense, guys, on how to use the fib on a buy. It's such an important tool. And again, if it doesn't make sense, I'll do one more small thing towards the end just to show it to you. But it's very important, you understand. Now, someone asked for gold real quick. I have overshot my time. I'm going to do some gold.
Mr. Masiri?
That sounds like, yes, sir. How are you doing?
Yeah, I'm good. Yeah, fantastic. The last thing that you see, what we have just said right now about locking profits.
Yes, sir.
Yeah, do we do that on a swing trade or on a daily trade?
Yeah, so Mr. Maroke, I'm just going to talk our language, right? Because you're still in the academy. You can do it on any day or swing. It just depends on what trader you are. The day traders, sir, are going to have to find those order blocks. Remember our order blocks, complicated 365 candles, Talitha areas, 365 candles, the engulfing patterns, all those different order blocks that are in the charts. They're going to have to find them on the 15 minutes or 30 minutes time frame. So as those order blocks are being created, they'll find them there. For swing traders, they have to find their order blocks to lock profits on the daily time frame. Does that make sense? Or on H4 and daily is fine. Does that make sense, sir?
Okay, yes, thank you.
Fantastic, man, fantastic. Right, so I've got some key levels drawn up on gold. I did a blog on gold. I'm very bullish on gold. Just repeat, I said we should buy there. This is gonna break. It's broken, and now I'm just waiting for the pump, waiting for a pump up. If it's okay with you guys, could I look at gold on a different chart so I don't delete all the analysis I've done there? Right, there we go. So same gold chart, but I teach on Saxo. First we have to identify a trend. Right? So for me, gold has been bearish, right? No one can deny that. But yeah, let's look at this. So there it is there. On the weekly time frame, you don't even need to use this just for retracements. You want to see where is price going, man. And that's really the job of a trader. You got to know the futuristic end, because remember, markets are futuristic. They price in their movement. That's a trend. A trend is I'm going up because I'm going somewhere far, or I'm going down and I'm going the slow. So look at this. We tracking this thing, and unfortunately right now, not unfortunately, gold has been very bullish, right? Look at that. This is no one can deny this. It's been bullish, breaking all-time highs from 2011. Gold is flying, right? And we know with the emergence of COVID, Trumpism, nationalism, politics, risk-on sentiment, blah, 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 gold had to pop. So from June 2020 last year, green. Every week since June 2020 up until August 2020 was just green, right? And then this happened. But what that means is, do I have a swing low? Swing high? If the answer is yes, pull out my fib. I pull out my Fibonacci because I know that there is a high, unless if it's a trend reversal, right? If it's a retracement and the trend hasn't given me signs of exhaustion, but instead buyers are taking profits, right? You have to take profits. Imagine you bought gold in June, right? You have to, at some point, you have to take your money out. And when smart money starts to take 20 million profits, TP hit 40 million, TP hit 60 million, banks hitting TPs, this thing has to drop. Private billionaire investors, TPs, has to drop, right? Same thing with Bitcoin. It has to react accordingly. So there you go. So you've got that area now. So you put out the Fibonacci, same thing. There's your lower wick. There's your area there. Right, and then you look carefully. Now, remember, this is on a big time. This is the weekly time frame. So you might have to drill down to see what a retail trader would have thought about. But there it is there, 50%. There it is there, 61.1%. Right, I'm going to mark this area for you. Carefully. The retail trader level, 50%. What's going on? Right, there we go. Retail trader area right there. I'm going to make this yellow, right? See that there? That 50, that's where price is now. When we started to realize that, oh my God, there's a swing low happening. There are people registering for tonight's class only now. I don't know if you guys can see these notifications coming in. And then there we go. Golden trade area right there, green. And all of you who are still around, thank you so much. I appreciate you for your time. Right, now, I've told you 61.8 all the way down, smart money. And again, right here, there isn't an order block, at least on the weekly time frame. Maybe on daily there is one, right? So let's just see what price did, because you guys kind of like should understand this by now, right? So it's just gonna dance around with price. 23.6, and these levels up here is what we call our PCP areas. It's not a full committed retracement. And a PCP is a potential continuation pattern, right? And we teach around that kind of stuff. It's not necessary for tonight's class. You will need to know it, right? Especially if the trend is strong. Sometimes price won't come all the way down. It will stop at a PCP level, right? And you can see That's what's really happening. Price is hovering, consolidating potential price pattern, and it's trying to decide as we speak, do I continue to go up? Do I have enough buyers? Can I convince them to go back? Remember, here is gold at doing an all-time high of 2,000. There we go. Failure, right? They don't get enough buyers to do that. So if PCP fails, price will drop. It drops dead into that retail level, right? That 50% area of that fib. You can see that there must have been some type of understanding. Let's pause this thing and just draw a horizontal line to the left, because I want you guys to see this. Maybe there's nothing there. Maybe there's something. I don't know. Boom, right? Right at the peak of the all-time high. That's where the 50% level is drawn. So there was massive resistance here. This was the all-time high, and then price dropped, right? Price couldn't maintain this. You see this resistance, right? That's how other retailers have conceptualized it, right? So we can see that this 50% level that I keep referring to speaks volumes to a type of trader. So price finds some type of sitting resistance tending to support. I don't know if you vibe with that kind of stuff. There it is. They're playing out. So there's price there trying its best to kind of like navigate, these things. And then these are the weekly time frames. So for 2 weeks, if you had a TP open for 2 weeks, you would have made money, right? Then you come back to where price was rejected. Naturally, you get a red candle. Price starts to fall back into that area. And it holds. And it drops, it holds, and it drops. It's zigzagging. I'm now in November. I'm just going to increase the speed. This is taking up a little bit of time. And then boom, price finally sinks into golden ratio area. So if you didn't close profits, you got smoked. That's the problem, right? And now I'm saying, the reason why I keep saying I'm bullish in gold, if you follow my blog, if you follow my 365 Traders page, I keep telling you guys I'm very bullish in gold. It's because gold entered the golden ratio area, and this is where price is today. And so you can see when gold broke all the stop losses that retail traders had in this level, in the golden ratio area, gold managed to bounce up, came back for a retest, and to me, because I'm bullish, it's simply trying to push up, right? And if it's pushing up, I'm gonna hold. I'm gonna hold for the all-time high. I'm a swing trader. I have no problem with that, right? Some of you might need to find entries. That's perfectly fine. We spoke about that in the war room last night, right? But I have no problem. I have no problem with waiting for gold this year to get there. It probably will. Maybe I'm wrong and I'm crazy. Markets will tell me. Ladies and gentlemen, it's 7:30. I have done 2 hours for you. I am... My voice box is tired, right? So if it's okay, I think we can wrap it up. I did say I was going to show you guys something in case for those of you who are struggling or you want to learn more about this kind of stuff. I don't want to waste too much time on this. Obviously, these are small snippets, obviously, from the overall academy, right? So let me just quickly share my screen for you so you can see it. This is what our remote access course looks like, right? I send this to you with a secure link, right? And you have this for life. And I keep updating. So every time I decide to teach a new course, I'm going to be doing stuff on stocks. I'm going to do module 3 this year, intraday trade. I'm going to do a whole stock market course. The problem is not the problem. Once you get this access, you pay for this access, you get it for life. So I keep updating. So this is what it looks like right now. So this is my full module 1, week 1, week 2, week 3. It's got everything. So every folder looks similar, right? It's going to have the teaching videos, what I'm introducing, and a PDF that I wrote for you for that week, right? And then it will continue all the way to module 2. I don't want to waste time, but it's literally, because people are like, he just showed us empty folders. That guy's a liar, right? So there it is there. So these are the things that we're talking about a little bit, right? And they go in and in. So that's module 1. When I teach it live, which I will be doing on the 9th of November, it takes about 5 to 6 weeks, right? So everyone who gets this is also welcome for free in the live classes, because then we can do questions. And this is what module 2 looks like. And if I go to week 2 of module 2, I'm hoping it's in here somewhere. I can't remember where it is. Supply and demand, importance, correct use, how to trade. It's not here. Maybe it's in another folder. Let's see. But the point is, all this stuff, right, we'll deal with in the live classes, but you also get to take this with you. So you can replay the videos yourself. You can actually kind of like figure it out, revise, etc., etc. This is the other folder. And the tools that we use. So Fibonacci tool is just one of the tools that we use in the academy. Thank you for your time. I'm exhausted. I hope this helped you. I hope it helped you one way or another. Tomorrow is the last public lecture of the week. I think I'll be doing market correlations, what pairs go with what is risk on. If you're selling pound USD, what should you be buying? What should you be selling? How do you hedge yourself in your trading MT4 account? And then Thursday and Friday, they're all private classes for students, how to trade indices. We're going to revise that quickly. Supply and demand curve, 50% black dot, which works with the fib, etc., etc. So if you're not a 365 student, our last free class together tomorrow, public lecture tomorrow is tomorrow. So I hope to see you. And then if you ever want to become a 365 student, I'll see you on the 9th of February, right? But until then, I'll find different ways to add value for free, obviously. Join our Telegram group, and also we'll do another war room next week, Monday. I think Monday was what was voted for yesterday by Mr. Johnson. Guys, thank you so much for your time. If you're on Facebook, shake my hand. Thank you again. If you're in the Zoom meeting, shake my hand. Have a good night, guys. Peace. Well, there are 5 charts. Okay, very helpful. Fantastic. Pleasure. Thank you. Thank you. Great, guys. All right. I got a panic thinking I missed out on. Thank you. Thank you. So many thank yous, guys. Truly, thank you for coming. It's been good insights. Thank you, George. Thank you. Thank you. Good clarification. Right. I appreciate all of you. I don't take this for granted. Like I said, no one did this for me. I struggled for a while. So if I can shorten your learning curve, that's all I want to do. It's so much money for everyone. It's too much, like literally. Right. I'm asking for the Telegram link. All right. Someone wants Telegram link. Don't log out of the Zoom meeting, Bridget. I'm gonna drop the Telegram link in the Zoom right now, if I can quickly find it for you. Okay. But everyone else, I'm done. But if you want the Telegram link and you don't have access to the Telegram link, just give me 2 seconds. I'll copy it for you. There we go. My angry dogs. Angry dogs. So I'm just looking for the link. But guys, thank you, Facebook people. Thank you, thank you, thank you. Come on. Link is copied. Right, there we go. Bridget, here's the link for the Telegram group in the chat box. Oops, nope. I sent it to a direct message. I'm saying to everyone, chat. So let's try that again. Okay, you should see it now. So that's the link to our Telegram group. Guys, apart from that, I truly appreciate you. Yeah, people are in the Telegram group are still sharing trades. Interesting. People are making money. Fantastic, guys. I'm happy. I'm very happy. Who's still around? Right. Cheers. Goodbye. Miss Bridget, I'm going to close the Zoom. So just confirm that. Can I do a... Yes, you can. You can with $110, but you must be very careful with your lot sizing, right? Your lot sizing is key. You have to be patient. You have to use 0.01. It doesn't matter what people say. You can't become a millionaire with 0.01. I'll tell you my life story. I held a trade. It was oil, and I had a gold trade, and I had USD CAD bullish because oil was doing very well. So I understood how markets worked. All 3 of them at 0.01, I held them for 365 days, and I got myself out of debt, right? The naming of my academy, 365 represents 1 full year I dedicated myself to following rules, and my life was never the same again. I call it the 3016 pips story, because oil is a good thing for Canada. When oil is good, Canada is good, because Canada is an oil export country. So I spotted those 3 moves, but I only had 0.01, and I refused to take profits for 365 days, and my account exploded. I'm not saying that's what you should do. I'm simply saying anyone who ever tells that 0.01 can't make you a millionaire just doesn't know what they're doing, right? It takes a lot of patience. It's very difficult. Markets retrace, they rebate, but we can teach you all that stuff in the academy because we use specific key charts to know when a trend is about to come to an end, right? But guys, again, thank you. Bridget, I don't want to leave you hanging. I do feel answered. I'm sorry. I see you asked me that on private message and I just blurted your name, but I hope that's okay. Does that make sense? Are you okay? Bridget, please let me know before I close the meeting. We're just waiting for Bridget. Any other questions? I just needed to confirm if she feels answered. Are you answered? Let me just type there. Are you good? Are you answered? Does that answer you? Right, guys, I don't want to hold error. Clear, fantastic. Right, there we go. There we go. Fantastic. Sure. Guys, have a good night once again. I'll see you tomorrow for the last public lecture of this week. Then I'll see you next week, Monday, for a war room. And then 365 students, we've got a lot of stuff to talk about tomorrow and Friday nights, right? Cheers, guys. Thank you once again. Facebook, love you. Cheers. I'm hungry.